EPK Capital presents Daily Brief, 29 August 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host Rutvik. In this series we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. Introduction: A Tale of Two Tapes, Resilience in the US, Riptides Abroad. Welcome to your daily global market and macroeconomic briefing. Today, August 28, 2025, the financial world witnessed a significant and telling divergence. On one side of the globe, U.S. markets navigated a stream of surprisingly strong economic data with a sense of calm and indecision, ending the day nearly unchanged. On the other, international markets, particularly in Asia, were caught in the powerful riptide of escalating trade tensions, with the tangible impact of new tariffs sending shockwaves through the Indian stock exchange. The day's narrative is defined by this contrast. In the United States, an upward revision to second quarter GDP and resilient labor market figures created a complex puzzle for investors and the Federal Reserve. This economic strength was juxtaposed against a brewing political drama in Washington, as President Trump's move against a Fed governor raised long-term questions about the central bank's independence. Meanwhile, the theoretical threat of a trade war became a painful reality for India, as newly effective U.S. tariffs triggered a sharp sell-off, providing a stark illustration of the real-world consequences of protectionist policies. And in the digital asset space, a landmark development for the Bitcoin network promises to reshape its utility, potentially evolving it from a simple store of value into a foundational layer for global finance. In this report, we will dissect these key events. We will begin with a snapshot of how global indices closed, followed by a deep dive into the conflicting signals from the U.S. economy. We will then analyze the political pressures at play, investigate the tariff turmoil that rocked Asian markets, and finally, explore the groundbreaking shift underway in the world of cryptocurrency. Section 1, The Closing Bell, a global snapshot. The trading day concluded with a picture of a fragmented global market. The United States ended its session in a state of equilibrium, with major indices hovering near the flatline, reflecting investor uncertainty. European bourses were mixed, with a notable slump in London standing out against the relative stability on the continent. Asia, however, presented the day's most dramatic contrast, with a bullish session in Japan overshadowed by a deeply bearish rout in India, directly linked to new geopolitical pressures. The table below provides a summary of the performance of key global indices for Thursday, August 28, 2025. The divergent figures immediately set the stage for the day's complex narrative, creating questions about the distinct forces driving each region's Section 2, U.S. markets. Strong data creates a Fed dilemma. The story of a flatline. The muted performance of the Dow Jones Industrial Average, S&P 500, and NASDAQ Composite was the defining feature of the U.S. trading session. This lack of clear direction was not born from a lack of news. On the contrary, the market was tasked with digesting a significant amount of high-impact economic data. The resulting flatline was a product of conflicting signals that left investors in a wait-and-see mode, balancing robust economic growth against its implications for future monetary policy. Macro Deep Dive. 1. Q2 GDP revised higher. The most significant economic release of the day was the second estimate of second quarter gross domestic product, GDP. The data revealed that the U.S. economy expanded at an annualized rate of 3.3%, a notable upward revision from the initial 3.0% print and stronger than the 3.0% consensus forecast. This marks the strongest quarter of economic growth since the third quarter of 2023, The drivers behind this upward revision were a pickup in consumer spending, which rose to a 1.6% pace, and a decrease in imports, which are a subtraction in the calculation of GDP. On the inflation front, the GDP price index came in at plus 2.0%, a positive sign for those looking for cooling price pressures. This release presented a significant conundrum for the Federal Reserve and the market. For months, investors have been pricing in a high probability of an interest rate cut at the Fed's September meeting, operating under the assumption that the economy was cooling sufficiently to warrant monetary easing. However, a robust GDP print of plus 3.3% directly contradicts the narrative of a rapidly slowing economy. This creates a fundamental conflict. The market desires a rate cut to stimulate asset prices, but this strong economic data provides the Federal Reserve with a compelling reason to pause and maintain its data-dependent stance. In this environment, the good news of a strong economy was simultaneously perceived as bad news for those anticipating a guaranteed rate cut. This internal conflict was a primary contributor to investor indecision and the market's sideways drift. Macro deep dive. 2. Jobless claims show labor market resilience. Reinforcing the theme of economic strength was the weekly report on jobless claims. Initial claims for unemployment benefits for the week ending August 23rd fell by 5,000 to 229,000, coming in just below the forecast of 230,000. Continuing claims, which track the total number of people receiving benefits, also moderated slightly to 1.95 million. This data reinforces the no hire, no fire economy theme that economists have been discussing. Layoffs remain at historically low levels, indicating that companies are holding on to their existing workforce despite broader economic uncertainty. While other recent data has pointed to a significant slowdown in the pace of new hiring, the low level of claims suggests the labor market is not showing signs of widespread distress. Much like the GDP report, the strong jobs data did not spark a market rally. Fundamentally, low jobless claims are a sign of economic health. However, in the current market context, this health further diminishes the urgency for the Federal Reserve to cut interest rates. The market has entered a phase where moderately good economic news is viewed neutrally, or even slightly negatively, because it reduces the likelihood of supportive monetary stimulus. The combination of a strong GDP revision and a resilient labor market report effectively tempered expectations for an imminent and aggressive easing cycle from the Fed, removing a key potential catalyst for upward market momentum. Section 3. The political factor, a test of Federal Reserve independence. Adding another layer of complexity to the market narrative was a significant political development emanating from the White House. Earlier in the week, President Donald Trump stated he would fire Federal Reserve Governor Lisa Cook, and on Wednesday, it was reported that a lawyer for Cook would be filing a lawsuit in response. This move strikes at the heart of a core tenet of modern finance: central bank independence. The Federal Reserve's ability to make monetary policy decisions based on economic data, namely inflation and employment, without political interference, is considered a cornerstone of the U.S. financial system's stability. This independence fosters global confidence in the U.S. dollar and the vast $29 trillion Treasury market. Any perceived threat to this independence is a matter of serious concern for global investors. Despite the gravity of the situation, the immediate market reaction in the bond market was muted, with no dramatic spike in Treasury yields. This lack of a volatile response points to a silent risk that is now being priced into the long-term outlook. The market is not reacting violently because the legality and procedural viability of firing a Fed governor are unclear and largely unprecedented, leading many investors to adopt a wait-and-see approach. However, the attempt itself introduces a significant long-term risk. International investors hold trillions of dollars in U.S. government debt, predicated on the trust that the Fed will act as a responsible, apolitical steward of the currency. If these investors begin to believe that the Fed might be pressured into cutting interest rates for political reasons rather than economic necessity, they will logically begin to fear higher inflation in the future. To compensate for this heightened inflation risk, investors would demand higher yields on long-term government bonds. This would lead to a steeper yield curve, raising borrowing costs for the U.S. government, corporations, and consumers alike. Ultimately, such a scenario would act as a drag on the very economy the political pressure was intended to stimulate, setting up what one report described as a collision course between political desires for lower rates and the bond market's demand for fiscal discipline. Section 4. The tariff effect. Indian markets bear the brunt. While U.S. markets grappled with conflicting domestic signals, the story in India was one of stark clarity. Indian equities experienced a sharp and painful sell-off, providing a clear demonstration of the real-world impact of U.S. trade policy. The BSE Sensex plunged 705.97 points, or 0.87% to close at 80,080, while the NSE Nifty 50 fell 211.15 points, or 0.85% to end the day at 24,590.9. The rout erased approximately Rs 4.67 lakh crore in market value from companies listed on the BSE. The direct and undisputed cause of this market carnage was the implementation of new U.S. tariffs, which came into effect on Wednesday. These additional punitive tariffs have raised the duty on a wide range of Indian goods to 50%, clouding the near-term outlook for the nation's exporters. The selling pressure was broad-based, with nearly all sectoral gauges settling with losses. The sectors hit hardest were those with direct export exposure or high sensitivity to overall economic sentiment. The Nifty IT index fell 1.59%, followed by Nifty Realty, 1.5%, Nifty PSU Bank, 1.03%, and Nifty FMCG, 1.02%. Market participants now fear prolonged pressure on labor-intensive, export-oriented sectors such as textiles, apparel, gems and jewelry, and leather goods, all of which are heavily reliant on the U.S. market. However, juxtaposed against this negative external shock was a counter-narrative of domestic strength. Data released on Thursday for India's Index of Industrial Production, IIP, showed that output for July accelerated to a 4-month high of 3.5%. This was driven by a robust 5.4% growth in the crucial manufacturing sector, its best performance in 6 months. This creates a critical tension for investors weighing the future of the Indian market. The immediate story is overwhelmingly negative, driven by a significant geopolitical trade conflict. The sharp market decline is a direct and rational reaction to this external headwind. Yet, the underlying domestic economic data, particularly in manufacturing and construction inputs, shows signs of resilience and recovery. This suggests a potential divergence within the market itself. While export-oriented stocks are being justifiably punished, the data on domestic strength may lead investors to seek opportunities in companies focused on India's vast internal consumption and infrastructure themes. As noted by Dr. V.K. Vijayakumar of Geojit Investments, investors may begin to rotate out of overheated small caps and into more fairly valued large cap consumption plays to find better protection from the tariff impact. Section 5. A tour of global markets. Europe's mixed session. European markets closed a cautious session with a mixed performance. In the United Kingdom, the FTSE 100 index fell by 0.42%. This decline was not driven by broad macroeconomic fears, but rather by a technical factor. Several major constituents of the index, including insurer Aviva, were trading ex-dividend. When a stock goes ex-dividend, its price typically drops by an amount equivalent to the dividend payout, as new buyers are no longer entitled to that payment. This mechanical pressure on several heavyweight stocks was the primary reason for the index's underperformance. On the continent, Germany's DAX and France's CAC 40 ended the day with flat to slightly positive performance. The cautious mood was influenced by the latest economic data from the euro area. A report from the European Commission showed that the economic sentiment indicator edged down to 95.2 in August, reflecting lower confidence in the services and construction sectors, as well as among consumers. This dip in sentiment capped any potential for a significant rally, leaving the major continental indices to tread water. Strength in Japan. In stark contrast to the rest of the world, Japan's stock market posted a solid day of gains. The Nikkei 225 index climbed 0.73% to close near 42,129. This outperformance was attributed to two main factors. First, strong domestic corporate earnings reports have continued to bolster investor confidence in Japan's corporate outlook. Second, global investor optimism remains high for the artificial intelligence and semiconductor sectors, where Japan is home to many key companies. This sustained bullishness on the AI theme provided a powerful tailwind for the technology-heavy index. China's cautious optimism. Mainland Chinese markets were largely muted during the session. While the underlying economic concerns and ongoing trade friction with the U.S. remain, a key piece of news prevented a significant sell-off. China's Ministry of Commerce announced on Thursday that a trade delegation, led by a vice commerce minister, will visit Washington, D.C. to meet with U.S. officials. This news, signaling a continuation of dialogue, was enough to keep markets stable. However, without a concrete outcome from these talks, investors remained on the sidelines, adopting a wait-and-see attitude. Section 6. Crypto's next chapter, a paradigm shift for Bitcoin. The main event, Tether's USDT comes home to Bitcoin. The most significant news in the digital asset space on August 28th was a landmark announcement from Tether, the issuer of the world's largest stablecoin, USDT. The company revealed its plans to launch USDT natively on the Bitcoin network through a next-generation protocol known as RGB. In simple terms, RGB is a smart contract and asset issuance system that operates as a second and third layer on top of the Bitcoin network. Crucially, it uses a concept called client-side validation, which means that most of the transaction data for assets issued on RGB is kept off-chain and verified privately between the sender and receiver, rather than being broadcast publicly on the main Bitcoin blockchain. This integration brings a suite of game-changing features to using a dollar-pegged stablecoin on the world's most secure blockchain. The benefits include enhanced privacy. As transaction details are not public on the base layer, user privacy is significantly improved compared to transactions on transparent blockchains like Ethereum or Tron. Scalability and lower costs. By keeping data off-chain, RGB avoids bloating the main Bitcoin blockchain, leading to near-instant transfers and dramatically lower transaction costs. Lightning Network. Compatibility. RGB is designed to be compatible with the Lightning Network, Bitcoin's primary scaling solution. This enables USDT to be used for high-speed, low-cost micropayments, remittances, and retail transactions. This development represents a fundamental evolution of Bitcoin's utility. For years, the primary narrative surrounding Bitcoin has been its role as a decentralized store of value, or digital gold, with its slow transaction times and relatively high fees, making it impractical for everyday payments. The native integration of USDT, the most liquid and widely used stablecoin in the world, via a scalable and private protocol like RGB, directly challenges this limitation. It positions the Bitcoin network not just as a place to store value, but as the foundational security layer upon which to transact in a dollar-equivalent asset. This move is a direct competitive threat to other smart contract platforms like Ethereum and Tron, which have historically dominated stablecoin activity. It has the potential to unlock a new wave of development and value accrual for the entire Bitcoin ecosystem, a sentiment reflected in the market's immediate positive reaction, with related Bitcoin ecosystem tokens like Stacks, STX, rallying on the news. Sovereign adoption, the Texas Bitcoin Reserve. Adding to the bullish sentiment, another piece of landmark news emerged on the same day. The state of Texas officially established a Bitcoin reserve through the passage of Bill SB 21. This move marks a pivotal moment in the institutional adoption of Bitcoin by a sovereign entity within the United States. The confluence of these two major developments creates a powerful, two-pronged bull case for the digital asset. The RGB protocol news provides profound technological validation for Bitcoin's expanding utility and its future as a transactional network. Simultaneously, the Texas Reserve News provides significant political and institutional validation for Bitcoin's role as a legitimate reserve asset. The occurrence of these two independent, majorly bullish events on the same day creates a powerful narrative synergy that strengthens the long-term investment case for Bitcoin and accelerates its journey into the financial mainstream. As of Thursday, Bitcoin was trading steadily around $113,078. Analysts are closely watching the $109,000 level as a crucial line of support. A break below this could trigger a broader short-term correction. In summary, the events of August 28, 2025 painted a complex and divergent picture of the global financial landscape. Four key themes have emerged that will shape the narrative in the days and weeks to come. First, the U.S. economy is demonstrating surprising strength with robust GDP growth and a resilient labor market. This good news has created a policy headache for the Federal Reserve, complicating the market's expectations for an imminent interest rate cut. Second, the political pressure being exerted on the Federal Reserve represents a significant long-term risk. While the market's immediate reaction has been muted, any erosion of central bank independence could have serious consequences for borrowing costs and confidence in U.S. assets down the line. Third, U.S. tariffs are no longer a distant threat, but a present reality with immediate and negative consequences for targeted markets. The sharp sell-off in India serves as a potent reminder of the disruptive power of protectionist trade policies. Finally, the cryptocurrency space witnessed a potentially historic day. Major advancements in both Bitcoin's technological utility through the RGB protocol and its institutional adoption via the state of Texas have powerfully reinforced the long-term bullish narrative for the asset class. Looking ahead, investors will be keenly focused on tomorrow's release of the U.S. Personal Consumption Expenditures (PCE) price index, the Federal Reserve's preferred measure of inflation. Any official statements or outcomes from the upcoming U.S.-China trade talks in Washington will also be critical. And finally, the market will continue to digest the real-world impact of tariffs on corporate earnings and global supply chains. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget to subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.